Very good afternoon to all my honorable speakers, professional colleagues, and my dear friends. Today, I am Priya Gupta. Welcome you all in the today's virtual CPE meeting on the topic accounting standards. Today, our speaker will be telling us regarding IND AS 2, IND AS 16, and IND AS 32. I would also like to request attendees to mark their attendance by writing down their name in the chat box and along with their membership number. Attendees are also requested to write down their queries in the chat box. Our team shall be dealing with them at the end of the session. Friends, now I take the opportunity to introduce our speaker by words. C. Nitish Kumar Chugh ji. He is a qualified chartered accountant, company secretary, along with the courses of DISA, DIRM, and a registered valuer. He is having experience of more than 15 years in the field of assurance and has been instrumental in designing and implementing the quality processes. He is also registered as valuer for asset class securities or financial assets with Insolvency and Bankruptcy Board of India, being first registered valuer from ICI Registered Valuers Organization. He is also registered as an insolvency professional with Insolvency and Bankruptcy Board of India and paneled with NCLT New Delhi Zone for appointment as interim resolution professional, IRP, liquidator, resolution professionals, and bankruptcy trustee. He is also empaneled as administrator under SEBI and Procedure Regulations 2018. He is also empaneled under Independent Directors Data Bank and has cleared online self-proficiency exam. Now I request CA Nitish Kumar ji to address us on the topic. Over to you, sir.
Thank you, Priya ji. Thank you for such a nice introduction and beautiful words. I sincerely thanks all the managing committee members, Anil ji, and other managing committee members for inviting me on this platform for sharing my knowledge on IND AS. I think we'll be taking queries at the end of the session, or you want me to take queries in the middle also?
So at the end of the session, I think it would be better.
Okay, not an issue. So let me start my deliberation. We'll start with the IND AS 2 on inventories. I hope my screen is visible to everyone. Okay. So, the objective of the standard is to prescribe the accounting treatment for inventories, and the standard deals with the determination of the cost of inventories, its subsequent recognition as an expense, and the write-offs to the net realizable value in case there are any inventories which are not being sold in the market, or which in their net realizable value has been decreased, then it requires the measurement to be written down to net realizable values, and the differential needs to be charged to profit and loss. So this is the objective of the standard, and it also provides guidance on the techniques for the measurement of costs. So what are the techniques? Basically, there are two techniques: a standard cost method or retail method, and how to determine cost. So cost formula is being given by three methods. The first one is the specific identification, and then there is FIFO method. We all know what is FIFO method. And then the another one is weighted average cost method. LIFO has not been recognized anywhere in the world, so we'll not talk about that. So what is the, let us start with the definition of inventory. So inventories are assets that are in the form of material or supplies to be consumed in the production process or rendering of services. For example, a raw material. Any supply which is to be consumed in the production process or for rendering of services will be classified under the raw material category. For example, aluminum or steel in making of a car, or raw crude oil which is being imported by refineries to produce the petroleum products. So that is being classified under the head raw material. Then the next category is the inventories are assets in the process of production for such sale. In the process of production means basically a work in progress. For example, a partial completed ship which is meant for sale by the company, or if I take the above example, in case of us making of a car, so the car which is not yet been complete or to be classified as finished product, that will be work in progress. Then there are inventories which are held for the sale in the ordinary course of business, that is the finished goods. For example, goods held by retailer or distributor, cars being completed by the manufacturing companies, that are being held by the company itself, and it is classified under the head finished goods. Then the next topic is in measurement of inventories. So initial measurement is being done at cost. How cost is determined, that we'll study later. So and subsequently measurement inventories are measured at either lower of cost or NRV. So basically initial measurement is at cost and subsequent measurement is at lower of cost and net realizable value. So what is the definition of cost? Cost includes all costs incurred involved in bringing the inventory to their present location and condition. There could be three types of costs: purchase costs, conversion costs, or other costs. What are the elements of purchase costs? We'll study line by line. Purchase costs includes the purchase price, import duties or non-refundable taxes, taxes which are non-refundable. For example, in case of imported goods, it's the import duties, and in case of domestic good also, there are certain products on which GST is levied or excise duty is levied, and that is not refundable or not convertible. So these all form part of the purchase cost. Then there are transport handling charges, uh, that is also a part of cost. From that, we need to deduct the trade discounts and rebates, and need to add any other cost which is directly attributable for bringing the goods to their present location and condition. So these are the elements of purchase cost. And then let us move to now conversion costs. What are the conversion costs? Conversion cost from converting raw material into finished goods. This could include direct material, direct labor, any other direct costs, and a systematic allocation of fixed and variable production overheads. There could be other costs also. For example, the borrowing cost, which can be capitalized in certain cases as per the requirement of IND AS 23. Then how do we allocate the fixed and variable production overheads? So fixed production overheads, which are indirect cost of production, they remain constant regardless of the volume of production. So these are being allocated on a systematic basis based on the normal capacity. For example, depreciation and maintenance of factory building and equipment, and right to use assets which are used in the production process, they remain more or less constant. Of course, depreciation may change due to a number of shifts, but more or less it remains the same. And depreciation and maintenance of factory building is the one factor which remains, which is a variable production, which is having more significance of fixed production overhead. So fixed production overheads are allocated based on the normal capacity of the production facilities. What is the normal capacity? Normal capacity is the production expected to be achieved on an average over a number of periods or seasons under normal circumstances, taking into account the normal loss from plant maintenance. So under this COVID scenario, the production facilities have, reduced, or the production has not been that much. So this is not a normal capacity, not a normal scenario. In this scenario, the uh, overheads which will not be absorbed by the production will be directly charged to statement of profit and loss, and will not form part of the conversion cost. Like this, when production level are abnormally low, unallocated overheads are recognized as an expense in the period in which they are incurred. In period of abnormally high production, the amount of fixed overhead allocation to each unit of production is decreased so that inventories are not measured at above cost. So let us see what are the variable production overheads. Indirect costs of production that vary directly or nearly directly with the volume of production. For example, indirect material and indirect labor. Variable production overheads are allocated to each unit of production on the basis of actual use of the production facilities. Let us see a case study. Pluto Limited has a plant with the normal capacity to produce 5 lakh unit of a product per annum, and the expected fixed overhead is INR 15 lakhs. Fixed overheads on the basis of normal capacity is INR 3 per unit. That is simple mathematics, total cost divided by normal capacity, 15 lakh divided by 5 lakhs. Now in the three scenarios, three case studies, we need to determine what will be the amount of overheads that needs to be included in the cost of inventory. In case one, actual production is 5 lakh unit, case two, actual production is 3 lakh 75,000 unit, and actual production in case three is 7 lakh 50,000 units. So case one is quite clear. Normal production matches the actual production, so there will not be any under or over absorption of overheads. Uh, Fixed overheads on the basis of normal capacity and actual overhead will lead to the same figure of 15 lakhs, and 15 lakhs will be included in the cost of goods. In second scenario, 3 lakh 75,000 units. So there will be some amount of unabsorbed or abnormal losses, and overhead charges relating to 3 lakh 7 remaining units, 1 lakh 25,000 units calculated on the normal capacity will be charged to statement of profit and loss. Now let us see if we calculate what is the absorption rate. So 15 lakh divided by 3 lakh 75,000 units comes out to be 4 rupees per unit, right? But we have calculated rupees 3 as per the normal capacity. So the differential 1 rupees, if we load it in the inventory, it will lead to a very higher profit, and it will not, inventory will also be overstated. To avoid that, what we'll do, will absorb the overhead based upon the normal capacity at rupees 3 per unit on 3 lakh 75,000, and the differential amount, it comes to total amount comes to 11 lakh 25,000, and differential amount will be transferred to profit and loss account, and it will not be loaded onto inventory. In third scenario, if we load the total expense of 15 lakh by normal capacity charging rupees 3, then it will be over absorption of overheads. So that will not be correct. The correct scenario will be to divide the actual overheads divided by actual production and include it based upon the actual rate of, which in this case is come to rupees 2. Right. Let us have one more example on this. Suppose XYZ Shipping build aircrafts on a made to order basis on behalf of its customer. It borrows money from bank against the construction of ship. On completion of construction, the ship is sold to customer and money is received. It takes substantial amount of time for construction of the ship. Now, this is an example of other costs which I was talking earlier. Inventories that require a substantial period of time to bring them to a saleable condition are considered to be qualifying asset. Interest cost on such inventories is added to the cost of inventory and not charged to profit or loss account. The extent to which borrowing costs included will be determined based upon the requirement of IND AS 23 borrowing costs. What are the exclusions of the cost? So abnormal amounts of wasted material, labor, and other production, such as fire and damages, any loss on account of these factors will not be included in the cost of inventory. Storage cost. Storage cost is a big element in few industries also. So normally storage cost is not included in the cost of inventory unless it is necessary for the production process before a further production stage, such as storage cost of a trading business, or in case of refineries also, there are several processes in which storage cost is incurred. So that is necessary for the production process. It will be included in the cost of inventory. Otherwise, it will be expense of to profit and loss account. Then administrative overheads that do not bring the inventory to their present location and conditions, such as security charges, etc., will be charged to profit and loss. Selling costs, for example, commission, etc., these are all examples of the exclusions of cost. So we are discussing what are the techniques of measurement of cost. There are basically two factors. The first one is the standard cost or retail method. Uh, in most of the cases, we use standard cost, but in few industries also retail method is also used. The standard cost takes into account normal level of material, labor efficiency, and capacity utilization. And the standard requires it to be reviewed and revised regularly. And in retail method, the difference is cost is determined by reducing the gross margin from the sales value. So in case of many automobile industries, this retail method is used, where the number of inventories are very, very large, and the margin is fixed. Normally, retail method is used. Cost is determined by reducing the gross margin from the selling price of individual product, and the same is valid as the cost for the inventories. So this method is suitable only for inventories of large number of rapidly changing items with similar margins. Now let us come to the cost formula, how to determine costs. Cost is being determined by three methods. The first one is specific identification, second one is FIFO, and the third one is weighted average cost. In case of specific identification of method, individual cost is required for items which are not interchangeable. There is a specific item and which cost has been incurred for that particular product only, and it is very, very well defined. It can be reliably measured also, and for these uh, for specific goods we use this specific identification method. And then the second method is the FIFO method. We all know FIFO is first in, first out. The goods which are being purchased first are used for manufacturing or are sold first. So whatever is the my stock, that will be considered from my latest purchases. Inventory at period end is most recently purchased or produced. Then the third method is weighted average cost. It is calculated from the cost of items at the beginning of the period and similar item purchased or produced during the period. So it's a mix of a weighted average. Basically, it's a weights of the average cost of opening stock as well as the production or items purchased during the year. Then another important term is the net realizable value, which is being dealt in by the standard. So NRV is the estimated selling price in the ordinary course of business, less the estimated cost of completion and estimated cost necessary to make the sale. So uh, let me read the definition again. NRV is the estimated selling price in the ordinary course of business, less the estimated cost of completion and estimated cost necessary to make the sale. So basically the cost of completion is also being reduced to calculate the NRV from the selling price, as well as the estimated cost which are necessary to make the sale is also reduced for determining NRV. So cost of inventories may not be recoverable due to damage, obsolescence, declining selling price, or additional costs needed to complete the manufacturing. NRV should be based upon the latest price or cost relating to events after the period end. Suppose we are valuing inventory as on 31st March. In this year, there was a complete lockdown due to COVID scenario. So NRV of various products have subsequently reduced. So while valuing the NRV, we need to consider the prices of goods after the balance sheet date also. We cannot say that the NRV of the product as on 31st March was this, so we'll value inventory as on 31st March prices. No, we have to consider the subsequent prices as well. And then there is the condition that in case the finished goods will be sold at a lower price due to reduce in prices and the margin is not enough, then material used in production are written off to written off to the extent there is insufficient profit. And its converse is reverse is material used in production are not written down below cost if the finished good will be sold at a profit. So if the finished good is sold at a profit even due to reduced prices, then there will be no reduction in the uh, prices of the raw material or any WIP. But in case finished goods is selling at a loss, then we need to factor in the loss in raw material as well as WIP also. So a review of NRV, the standard requires a review of NRV of all inventory should be made in each period. When circumstances causing write-off no longer exists, written down value can be reversed, which is not there in IGAP. There is a difference between IGAP and IND AS. IND AS allows you to write back the amount already written off due to lower NRV, whereas the same thing is not there in the accounting standard 2 as per IGAP. So let us see how NRV is calculated through an example. ABC Pharma is a renowned company in the field of pharmaceuticals, has the following two items in inventory. The cost or NRV has been given against item ABCD. In the total of the cost is 14,600 and NRV is 14,540. So how do we determine the cost or NRV? We need to see there are two basically methods of doing it. The first one is the item wise item basis and the second one is a group basis. So if I determine cost or NRV value of inventory, cost or NRV whichever is lower on an item by item basis, then my total will become 14,290. Whereas if I calculate it based on the group basis, it's 14,540. So as a practice, it is advisable to calculate it on a item by item basis. However, in certain circumstances, it may be appropriate to group similar or related items where there are, in case of manufacturing automobile segment also, where there are volumes are there and inventories are almost same with the same nature. So you can group there, but otherwise it is always advisable to calculate the NRV based upon NRV or cost. You compare the cost or NRV on an item by item basis. Then there is guidance on the cost to be allocated for joint products and byproducts. In a production process may result in more than one product being produced simultaneously, and this is a fit case of joint product. And in case there is no identifiable joint product and there is any other product which is being produced, they are called as byproduct. For example, if I say if when I am in a refinery, when the crude oil is being uh, when the crude oil is being used as raw material, the finished product is petroleum as well as diesel. So these are all the joint products. But there are certain byproduct also like naphtha or kerosene oil, which is not significant. When the cost of conversion of each product are not separately identifiable, the cost is allocated between the products on a rational and consistent basis. If the cost of the joint product is not separately identifiable, it is being allocated on a rational and consistent basis. For example, based on the sale value of each product, either at the production process stage or at the time when the same become identifiable. Uh, for byproducts, most of the byproducts by their nature are immaterial, and their cost is being determined, and NRV is being reduced from the total cost. So suppose if I say in a refinery, naphtha is the byproduct. So whatever selling price we are getting by sale of naphtha, that that amount will reduce the actual cost of the main product. So I'll read it again for you. When this most byproducts by their nature are immaterial. When this is the case, they are often measured at NRV, and this value is deducted from the cost of the main product. As a result, the carrying amount of the main product is not materially different from its cost. Now let us come to the recognition as an expense. When inventories are sold, their carrying amount is recognized as expense in the period in which related revenue is recognized. So whatever is the carrying amount that is there in the books of accounts is recognized as an expense at the time of sale. Write downs to NRV and all losses of inventories are as an expense in the period in which, in case there is any write down to inventory due to reduction in the NRV or any other loss, that is recognized as an expense in the period in which it is incurred. Similarly, if there is any reversal of any write down of inventories, the same is reversed in profit and loss account and it's reduced from the expense recognized on the as per the recognition criteria. Then there is guidance on inventory that is being transferred to property, plant and equipment as well. Some inventories may be allocated to other assets account. For example, inventory used as a component of self-constructed property, plant or equipment. In such scenario, whatever is the carrying amount of inventory that is not recognized as an expense and immediately, but over a period of useful life of that particular property, plant and equipment by way of depreciation. For example, an item of inventory costing rupees 20,000 as covered under IND AS 2 is consumed in the construction of self-constructed property and recognized as property, plant and equipment under IND AS 16. The cost of PPE other than inventory is 80,000. So the total cost of PPP is 1 lakh and if its useful life is 5 years, then depreciation on such property will be charged at 20,000 rupees per annum. Instead of charging the inventory amount to expense, it will be capitalized and will be depreciated over the useful life of asset. Then there are certain disclosure requirements also relating to this standard. It's accounting policy. We need to disclose the accounting policy adopted in measuring inventories, including the cost formula used, analysis of carrying amount, total carrying amount of inventories as per the classification given in Schedule 3. Then inventories which are being carried at fair value less cost to sell. The amount of inventory is recognized as an expense. The amount of any write down or any reversal of write down and events or circumstances that led to such reversals. Then carrying amount of inventories that is being pledged as securities for any borrowings or any liabilities. There are few differences between the IND AS and IGAP. Let me cover that as well. So the first is relating to measurement. Measurement requirement of IND AS do not apply to inventories held by commodity broker traders. So this standard does not apply to commodity broker traders, whereas there is no such exemption in AS2 for inventories held by commodity traders. Uh, Also, biological assets related to agricultural activity and agriculture produce at the point of harvest are also scoped out from this accounting standards. Whereas AS2 AS2 में हमारा WIP under construction contract has been scoped out and livestock, agriculture and foreign products, they are all being measured at NRV. Similar guidance is not there in IND AS. Then one major difference that is there in IND AS and IGAP is relating to deferred settlement terms. So purchase price under normal terms less actual price paid under deferred terms is recognized as an expense. For example, if you have purchased any item of inventory for which payment is deferred over a period of time more than 12 months, then the same will be accounted for at present value and differential will be treated as interest expense over that period. No such guidance is there in AS2. It simply ignore this time value of money concept. Then regarding the cost formula, it is mandatory to use same cost formula consistently for all inventories that have a similar nature and use. Whereas AS2 requires us to, specifically provide that formula used in determining the cost of inventory should reflect the fairest possible approximation to the cost incurred in bringing the items of inventory to their present location. Then regarding to reversal of write down, this we have already discussed. Reversal is permitted in IND AS 2. There is no specific guidance in Indian GAAP, and subsequent recognition is not being covered in the IGAP. It is being covered only in IND AS, which we have just studied. So this is all about inventories AS2, IND AS 2. So you want me to take the queries relating to this particular IND AS or all the three together? Priyaji?
Uh, so there's no issue if we continue with the another IND AS right now, and then we may take the queries at the end of the
Okay,
session.
okay. So let me start the other IND AS, right?
Yeah.
Just wanted to ask whether I am too fast or is it okay? The pace is okay. Okay. So the next IND AS that we are discussing, that we'll discuss right now, is IND AS 16, a very important IND AS on property, plant, and equipment. So the objective of this IND AS is to prescribe the accounting treatment for property, plant, and equipment, and provide specific guidance on recognition of asset, determination of the carrying amount, accounting for depreciation, recognition of decommissioning, restoration, and similar liabilities. Accounting for all PPE, the scope is covering the accounting for all PPE unless the standard requires or permits a different treatment, and it does not apply to PPE classified as held for sale. There is a specific IND AS 105 on this. Then there is a specific IND AS for biological asset, IND AS 41, which is being biological assets is scoped out from this IND AS. Exploration and evaluation assets, IND AS 106, and mineral rights and mineral reserves, all these have been scoped out from this particular IND AS. Let us straight away move to definitions, tangible items. So, what is a tangible item? It is held for use in the production, any asset which is held for use in the production or supply of goods or services, or rental to others or for administrative purposes, and their use is expected to be more than one period. More than one period means 12 months. So if there is any asset which is used in the production or supply of goods or services or for rental purposes or for administrative purposes and their use is expected to be more than one period, then the same will be classified under this IND AS as tangible assets. The recognition criteria for PPE PPE is initially measured at cost. However, PPE shall be recognized as and when PPE shall be recognized as an asset where there is future economic benefits are probable and their costs can be reliably. Its cost can be measured reliably. Then there are certain other criteria which is like initial acquisition or construction cost and subsequent cost, which we'll study later in this PPT only. So what are the elements of cost? Cost of elements is again the same like we have discussed in the previous accounting standard: purchase cost, directly attributable cost, and other costs. In this case, purchase cost will include purchase price, import duties, non-refundable taxes. Then we need to reduce the trade discount and rebates. Directly attributable costs include the cost of employee benefit, cost of site restoration, initial delivery and handling costs, transport handling charges, installation charges, testing fees, professional fees, etc., etc. And other costs includes initial estimate of dismantling cost, and initial estimate of site restoration cost. So this is a new concept which has been brought in by IND AS, and now amendments have been made in IGAP also. The same concept has been introduced in IGAP also. So the what is dismantling cost, and we'll study this in later. So there is one more element of other cost which is not mentioned in the PPT, that is the borrowing cost that we have discussed in previous standard also. It's the same in case of a qualifying asset. The borrowing cost is capitalized based upon the requirements of IND AS 23. There are certain exclusions also which are not considered at part of cost, such as cost of opening a new facility. If we have opened a new facility and there is no future economic benefits from the same, or recognition criteria is not met, and therefore these are not being included at part of cost. Then cost of introducing a new product or services, or conducting business in a new location with a new class of customer, any administrative or general overheads. All these costs are generally does not have any future economic benefits, so these are not considered as part of cost. So let us have a quick case study. ABC is installing a new plant at its production facility and has incurred following cost. The cost of plant is INR 25 lakhs. Initial delivery and handling charges 2 lakh rupees. Cost of site preparation 6 lakh rupees. Consultants used for acquisition of the plant 7 lakh rupees. Interest charges paid to supplier of plant for deferred credit 2 lakh rupees. Present value of estimated dismantling cost to be incurred after 7 years, that is rupees 3 lakhs. So we have studied all these to be part of the uh, uh, elements of cost, except the interest charges paid to supplier of plant for deferred credit. So let us see what is the cost. Cost of the total cost to be capitalized is to be cost of the plant, initial delivery cost, site preparation cost, consultant fee, and present value. The only exclusion in there is the interest charges based on deferred credit terms to the supplier of plant of rupees 2 lakhs, which it cannot be capitalized since there is no qualifying asset. The cost should be written off to statement of profit and loss as and when incurred. Then subsequent measurement, there are two models. The first one is the cost model. In this cost model, uh, uh, value of asset is carried at cost less any accumulated depreciation or any accumulated impairment losses, and cost is depreciated over the useful life of the asset. Then there is another model, that is the revaluation model. In this, the asset value of asset is carried at revalued amount, that is the fair value at date of revaluation. Fair value at date of revaluation less any accumulated depreciation and any accumulated impairment losses. The revalued amount is depreciated over the useful life. So, what is the evaluation model and how the accounting for the same is being done? In case there is an increase in carrying value of an asset, if we say yes, there is an increase in the carrying value due to revaluation, then whatever is the gain, it is recognized directly in the other comprehensive income and in equity as revaluation surplus. Then increases there are certain criteria also in case there is any revaluation decrease which we have accounted for earlier. Let us first study how the decrease will be accounted for. So we have still now studied the increase will be recognized directly in OCI and equity as revaluation reserve, and if there is any decrease in the carrying value of an asset due to revaluation, then it has to be charged to profit and loss account. However, if there has been any previous increase and revaluation reserves are being accounted for, then subsequent reduction will be adjusted from the revaluation reserves. Am I clear? And similarly, in case of increase in asset, the amount will be credited to OCI and recognized as equity in equity as revaluation surplus. However, if there has been a previous decrease which has been recognized in profit and loss, then it will, to that extent, it will be credited to profit and loss account. मतलब जो इवेंट पहले हुआ है इंक्रीज का और जो सब्सिक्वेंट इवेंट हुआ है उसी में से ही एडजस्टमेंट होगी. अगर इंक्रीज पहले हुआ है तो ओसीआई में जाएगा, अगर डिक्रीज पहले हुआ है तो प्रॉफिट एंड लॉस में जाएगा, और सब्सिक्वेंटली अगर कुछ हुआ है तो उसी प्रोसेस टू दैट एक्सटेंट वो अमाउंट रिवर्स होगा. Then there are certain conditions that entire amount of property, plant and equipment shall be revalued, and revaluation shall be done with sufficiently on a regular basis. The revaluation surplus may be transferred to retained earnings when the asset is de-recognized or as it is used by the entity. So let us see this one example. In case one, the cost of the asset or the carrying amount is 10,000 rupees. It is being revalued at 8,000. So first transaction is the decrease in carrying value due to revaluation. It will be charged to profit and loss. Profit and loss will be debited by the amount of 10,000 minus 8,000, 2,000 rupees, and asset will be credited. Now, subsequently, the asset is again revalued at 5,000. In case one, asset is again revalued at 5,000. So same treatment will be done. 8,000 minus 5,000, 3,000 will be the amount to be charged to profit and loss account as revaluation loss. And asset will also be credited by the same amount. So case two, where the amount has increased to 11,000 rupees. So if you see the total revalued amount is more than the original carrying cost. So to the extent of carrying cost, it will be credited to profit and loss account. From 8,000 to 10,000, 2,000 will be credited to profit and loss account, and over and above the carrying cost, whatever is the amount, 11,000 minus 10,000, 1,000 will be credited to revaluation surplus. And of course, the differential debited to asset account. I hope this is clear. Then let us see the second example in which revaluation increase is the first transaction. Carrying amount is 10,000. Revalued amount is 12,000. So in that case, revaluation surplus will be credited by 2,000 rupees and asset will be debited by 2,000 rupees. This is simple. This revaluation surplus will be accounted for in OCI. Now, subsequently, there is a reduction in the revaluation amount and it has reduced to 9,000. Now, when it is reduced to 9,000, so whatever is the differential which we have credited to revaluation surplus earlier will be debited. It will be reversed. So 2,000 will credited to revaluation surplus will be debited this time, and the differential 1,000, 10,000 minus 9,000 will be charged to profit and loss account, with crediting the asset by 3,000 rupees. And in fourth scenario, the amount is again revalued from 12,000 to 15,000. The differential of 3,000 will again be credited to revaluation surplus. In this, we have ignored the depreciation for the sake of simplicity. Then there is one more concept of subsequent cost, that is major inspection and overall cost. So in case there is, there are certain costs for which are being incurred regularly. Performing regular major inspection for fault, regardless of parts being replaced or not, may be a condition of continuing to operate an item of property, plant, and equipment. For example, if we talk about airline or aviation industry, if they need to, the aircraft need to fly, there are certain scheduled uh, major inspections and overhauling of the engine is being done after a specified period. That is the requirement of the regulator. In such case, these subsequent costs, they meet the recognition. If they meet the recognition criteria, then these are being capitalized in the cost of asset, carrying value of asset. And if there is any remaining amount, and these are being charged on depreciation on this being charged separately from the other asset. We'll see componentization also. Component accounting में इसका भी एक part आएगा. So if there is any remaining amount, suppose there is a scheduled inspection after every 3 years or overall cost every 3 years, which has been capitalized and depreciation is being charged on the same for 3 years by taking life as 3 years. But due to some reason, this overall cost need to be incurred after 2 years. So there will be some remaining carrying amount of the asset from the previous inspection that will be charged to profit and loss account immediately. Now, how do we charge depreciation? All assets with a finite useful life must be depreciated, and depreciation begins when the asset is available for use and continues until the asset is derecognized or classified as held for sale. The residual value of an asset is the estimated amount that an entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal, if the assets were already of the age and in the condition expected at the end of useful life. So basically, you need to estimate at the end of the useful life what will be my selling price of the particular asset and what will be the cost of disposal. Normally, we take 5% as the residual value and we charge depreciation at the 95% value. So, depreciation, the residual value and useful life on assets shall be reviewed at, at least at each financial year. This is the specific requirement of the standard. And if the expectations are, the changes shall be accounted for as change in the accounting estimate. So now, if there is any change in the useful life or residual value, then the same will be accounted for as an accounting estimate, change in accounting estimate. पहले हम इसको retrospective भी effect देते थे, but this is not as per IND AS. This is a change in accounting estimates and it has to be prospectively applied. अगर 4 years की life आपने 5 years कर दी determined at the end of any financial year, then the carrying value will be depreciated over the remaining useful life of 5 years, considering the revised useful life. Depreciation shall be allocated on a systematic basis over its useful life, and depreciable amount is equal to cost minus the residual value. Now, there are three methods of charging depreciation which is being prescribed by the standard. The first one is the straight line method, the other one is diminishing balance method, that is WDV, and the third one is the unit of product method, UOP method. We all know about all these methods. The method used shall the standard required that method used shall reflect the pattern in which the asset future economic benefits are expected to be consumed by the entity. So there should be a justification of charging a justification for applying a particular method. For example, in an automobile industry, if the life of a die is 3 years and the number of units from the particular die that will be produced is fixed. In that scenario, the depreciation, it is advisable to charge depreciation based on the unit of production method instead of SLM or WDV. So the method that an entity is using should reflect the pattern in which the asset future economic benefits are expected to be consumed by the entity. And it should be reviewed at least at each financial year. If there is a significant change in the expected pattern of consuming future economic benefits, then method shall be changed to reflect new pattern, and it should be accounted for again as an accounting estimate prospectively. No retrospective adjustment needs to be done. For example, let us see an example. XYZ purchased an asset on 1st April 2010 for INR 1 lakh, and the asset had an estimated useful life of 10 years and a residual value of nil. The entity has charged depreciation using the straight line method at INR 10,000 per annum. 1 lakh divided by 10. On 1st April 2014, after 4 years, when the asset net book value is INR 60,000, the directors reviewed the estimated life and decided that the asset will probably useful for further 4 years, and therefore the total life is revised to 8 years. So now the carrying value is 60,000 and new life is 8 years. So as I told you earlier also, this is nothing but change in accounting estimates only. So in this case, the company should amend the annual provision for depreciation to charge the unamortized cost 60,000 over the revised remaining life. Consequently, it should change depreciation for next 4 years at INR 15,000 per annum. The initial life was for 10 years. Now they have, after 4 years, they have estimated to be total life of 8 years. So carrying value of 60,000 is depreciated over the remaining useful life of 4 years, and annual depreciation charge is 15,000 per annum. Now let us see what is this component accounting is. It is a very, very important concept introduced in IND AS as well as in IGAP and through the Companies Act as well. So in case there is a significant item of property, plant and equipment is recognized and Suppose that there is a product, there is a machinery or PPE which have a there a parts which have different parts, and its cost is significant and its life is also different. For example, there is a ship which is having a one two components. The life of one component is 10 years and the life of other component is 3 years, and the cost is also significant. For example, in this which is being given, the docking cost, which is planned after every 3 years, and estimated cost is 15 lakhs. So this needs to be accounted for separately, and depreciation on the same is required to be charged separately based upon its useful life. There could be several components of a particular PPE having a significant cost. That there are two elements. The first one is the part should have a significant cost, and uh, the life has to be different. So in that case, it is to be depreciated over its useful life, which is different from the main component. In this case, ship costing 150, useful life is 10 years. Then there is estimated docking cost 15, planned after 3 years. So the cost will be total cost will be divided into two components. The first one is the major component 135. The second one is having costing of rupees 15, having different life of 3 years. And depreciation on this 15 will be charged based upon 3 years useful life, whereas on the major component costing rupees 135, life will be 10 years and depreciation will be charged considering 10 years. So what are the key consideration for componentization? How we identify this componentization? There could be materiality or significant components of a particular asset. It ऐसा नहीं है कि आपने कार परचेज करी और टायर उसकी सिग्निफिकेंट पार्ट बन गया. It has to be the cost has to be significant. Normally the criteria is 5%, or some companies may take it as 10%, 10% of the total cost of that particular asset. Then the useful life is also has to be different. So in an aircraft, the useful life of a engine is different as compared to electrical equipment, as compared to the uh, other parts, or you can say the body of the aircraft. Then we need to also take into consideration the replacement cost. That is, what are the parts that are being replaced over a period of time. So that will give us an indicator how to do the componentization. Then major inspection and overall cost, that is also considered separately from the total cost. For example, dry docking, etc. So this is an example of a building, how the main building and there are other uh, significant part can have a different useful life. For example, the elevators will definitely have a different useful life. Now, if I say the life of a building is 30 years, the elevators cannot have a life of 30 years at all. And if their cost is significant, these can be accounted for separately, and depreciation will be charged based upon the useful life of elevators. Then there could be fire protection system having different useful life, plumbing system, floor coverings, electrical and lighting system, HVAC, interior finishing, roof covering, everything. All these, if they are significant to that building and having a different useful life, needs to be uh, accounted for as a component of a particular asset, and depreciation to be charged based on their useful life. Then the concept of derecognition. An asset is derecognized, the carrying value of asset is derecognized on disposal, or when the future benefits are, or when no future benefits are expected from its use. So suppose if there are no future economic benefits from a particular asset, then uh, the asset needs to be derecognized. For example, in an automobile segment, if you say Maruti has discontinued a particular model, then the carrying value of the dies for that particular model will be derecognized unless and until it has an alternate use. So any gain or loss arising from derecognition, that is difference between carrying amount and net proceed from disposal of the asset, it should be accounted for in profit and loss account. Then there are certain disclosures requirement in this. The first one is the measurement basis, a depreciation method used, useful life or depreciation rates used, gross carrying amount, accumulated depreciation at the beginning of the year, at the end of the year. Similarly, gross carrying amount, as well as the reconciliation for the carrying amount at the beginning and the end of the year. Also, we need to disclose impairment, accumulated impairment losses if there is any at the beginning and at the end of the year. Then existence and amount of restriction on title of assets, uh, any asset being pledged as security for borrowings or liabilities. In case of revalued asset, there are certain disclosure requirement. Amount of expenditure recognized in the course of, no, this is not relating to revalued. This is related, these are certain additional disclosures. Amount of expenditure recognized in course of construction, contractual commitment for acquisition of PPE, amount of compensation from third parties for item of PPE. Then for revalued assets, we need to disclose the effective date of revaluation, whether an independent valuer was involved, then carrying amount of each class of revalued PPE if the cost model has been applied. So we need to disclose the carrying amount of each class of revalued PPE if we have not chosen the revaluation model. So in case any entity chooses the revaluation model, it has to disclose the values as per the cost model also. Then revaluation surplus, including any movement or restriction on distribution to of balance to shareholders. These are all the disclosure requirements. Let us take the third standard now. So this is relating to intangible assets, IND AS 38 intangible assets. So what is included in the objective and scope of the standard? This standard prescribes the accounting treatment for intangible assets, except there are certain exceptions which have been scoped out from this standard. Intangible assets held for sale in ordinary course of business, that has been accounted for as per IND AS 2 inventories. अगर आपने सेल करने के लिए उसको होल्ड किया हुआ है, then deferred tax asset is also not an intangible asset. Leases within the scope of IND AS 16, assets arising from employee benefits, goodwill acquired in a business combination. The treatment for the same is being given in 103 only. Non-current intangible asset classified as held for sale. For asset held for sale, whether it is tangible, intangible, the guidance is given in IND AS 105 itself. Financial assets, IND AS 32, exploration and evaluation assets 106. Let us see what is the definition of an intangible asset. So an intangible asset, it's an identifiable, the first word is identifiable, non-monetary asset without physical substance. So what are the parameters? It's an identifiable non-monetary asset without physical substance. What could be the examples? Patents, copyrights, licenses, intellectual properties, trademarks, etc. So an intangible asset is identifiable when it is separable and arises from contractual or other legal rights. Right? आइडेंटिफाइबल क्या हो सकता है? आइडेंटिफाइबिलिटी में क्या आएगा आपका? बेसिकली पेटेंट्स हो गए, कॉपीराइट्स हो गए, लाइसेंस हो गए, ट्रेडमार्क्स हो गए, which is separately identified from the assets, right? Uh, then we discuss what is the definition of asset. An asset is a resource. An asset is a resource controlled by an entity as a result of past events from which future economic benefits are expected to flow to the entity. For example, costs incurred for development of any patent or development cost of any know-how, right? So the entity has control over the same, and it has arisen out of the result of past events. And if there are future economic benefits which are expected to be flow to the entity, the same will be covered as an asset. So, how do we measure control in this? Control means the power to obtain the future economic benefits from the underlying resource and the ability to restrict the access of others to those benefits. So, if you have developed any software, so you have the control over the same, and if there are future economic benefits from the same, then the same is can be classified as an intangible asset and recognized in the books of accounts, since you have the ability to restrict the access of others to those benefits. अब future economic benefits क्या होते हैं? What are future economic benefits? Future economic benefits may include revenue from sale of products or services. कोई new product और services को sale कर रहे हैं, तो that is also future economic benefits. और cost saving हो रही है आपकी, आपने कोई ऐसे ही टेक्निकल कोई प्रोसेस क्रिएट किया है जिसकी वजह से देयर इज कॉस्ट सेविंग टू द एंटिटी, so in that scenario also future economic benefits will flow to the entity, और any other benefit resulting from the use of asset by the entity, और किसी भी तरीके का ऐसे कोई भी benefit entity को हो रहा है तो future economic benefits consider करे जाएंगे. Identifiability criteria कब met होता है? Identifiability criteria is met when an intangible item arises from contractual or other legal rights, or is capable of being separated or divided from the entity and sold, transfer, licensed, rented or exchanged. Suppose a technical know-how है, it is आप किसी के साथ कोई contractual arrangement करते हैं to transfer the knowledge, then it arises from the contractual or legal right, and it is capable of being separated. आपके employees हैं which can transfer the knowledge, and you can have royalty for the same over a period of time. So the identifiability criteria in that sense will be met. Control criteria is met on existence of legal right that are enforceable in court of law. Suppose in this example also, uh, if you have done any contract with a person for transfer of technical know-how, and there is a clause in the contract that this cannot be sublet or given to any other party, then in that scenario you have the control to restrict the asset from restrict the asset for a for use by general public or any other party. In that case, control criteria will be met. So there is an example. We need to identify whether these are tangible or intangible asset. The operating system of a personal computer. So operating system, you have purchased an asset from a market in which there are software such as Windows or any other software relating to the use of that particular computer. That will not be covered under the definition of intangible asset. That is more having features of a tangible asset. You have purchased a machine, and that is more having a significant value, so it will not be separately classified as intangible asset. Then the second one is an off-the-shelf integrated publishing software package. So you have purchased a publishing software package, so that will definitely fall under the category of intangible asset. Then specialized software embedded in computer controlled machine tools. So this is also having more feature of the first category. Any specific software which is in a embedded in a system or in a computer controlled robots or something for production purposes. So this will also not be classified as intangible, rather it will be classified as tangible, having more features of a tangible asset. Then a firewall controlling access to restricted sections of an internet website. So firewall controlling access to restricted section, that it is covered in the definition of intangible assets. So these are the responses to the example. The operating system Windows of personal computer is an integral part of the related hardware and should be accounted for under IND AS 16. Intangible, this off-the-shelf software packaging software which we have purchased is not an integral part and will be classified as an intangible asset. Then specialized software integrated into production line robots is similar to nature one and tangible, and firewall is an intangible asset. So what is the recognition criteria of intangible assets? It's the same that we have discussed in IND AS 16. It is probable that expected future economic benefits that are attributable to the entity will flow to the entity, and its cost can be measured reliably. So these are the only two criteria, recognition criteria. The probable expected future economic benefits will flow to the entity, and the cost of the asset can be measured reliably. An intangible asset should be measured at initially at cost. Same. If it's a separately acquired asset, then the cost will be purchase consideration paid to acquire the asset, intangible asset. If the acquisition is through a business combination, then uh, cost value equals the fair value in case for what is the fair value of asset as per IND AS 103, and the same will be recognized at the fair value. Then if you have acquired a group of intangible assets, this is interesting. If you have acquired a group of intangible assets without having significant knowledge of the cost price or purchase price of all the assets, then it will be cost will be allocated based on the relative fair value of that particular asset. So if a group of intangible assets have been acquired, then the cost will be allocated based on the relative fair value. This is initial measure done at cost. Now there is one more example. If any asset is intangible asset is acquired through government grant.
Please सर
Yes,
स्क्रीन इज नॉट प्रॉपर स्क्रीन पे पूरा फिक्स हो जाए उसको
it
दोबारा
is
शेयर
not
कर
possible. Okay, okay, मैं दोबारा शेयर कर
ओके
लेता हूँ.
ओके सर इतना वट इज हाँ आप दोबारा
मैं एक बार दोबारा कर लेता हूँ. Is it visible now?
Yes, it's visible now.
Okay. So asset acquired through government grant are being valued at fair are being recognized or measured initially measured at fair value, and internally generated intangibles. So internally they are being recognized or measured at the expenditure incurred in the development phase. Only in the development phase, whatever expenditure that has been incurred in research phase will be charged to profit and loss account. So from the date recognition criteria is met, any expenditure that has been incurred for the development will be classified or measured in the initial measurement criteria. For separate acquisition, the cost will include the purchase price, the import duties, non-refundable taxes, less the trade discount rebates, and directly attributable cost of preparing the asset. It includes the cost of introducing a new product or service, similar to IND AS 16 that we have just discussed, cost of conducting business in new location or with new class of customers, including the staff training cost, administration and other general overheads, initial operating losses, etc. So let us see an example. XYZ is an incorporated entity. On 31st March, it acquired the exclusive right to a patent that had been developed by another entity. The amount payable for the right was INR 9 lakhs immediately and INR 5 lakhs in 1 year's time. XYZ has incurred legal fees of 1 lakh in respect of the bid. XYZ operates in a jurisdiction where the government charges a flat rate fee, a stamp duty of INR 5,000 for the registration of patent rights. The cost of capital of the entity XYZ is 10%. Then we need to calculate the cost of the patent rights on initial recognition. Let us see what will be the cost for initial recognition. So the cash paid of 9 lakhs will be directly included in the cost part, that is the purchase price. Then there is a deferred consideration which is to be paid after 1 year, 5 lakh rupees. And since the cost of capital is 10%, we have discounted it to the present value. What is the present value as of today? 4,54,545. So this will form part of the cost, not the deferred payment of 5 lakh rupees. The differential between 5 lakh and the present value will be accounted for as interest expense. So this is a major change which initially there was from the IND AS and IGAP, but now the same concept has been introduced in IGAP property plant and equipment standard as well. Then there is a legal fees of 1 lakh rupees and stamp duty of 5,000. The total cost is 1459,545. So this is a chart which shows that research phase expenses, any expense which is being incurred during the research phase will be recognized directly and in the statement of profit and loss as expense. In case it is not clear whether it's a research or development, then also it will be on a conservative basis be charged to profit and loss. When it is very clear that the product is at a development phase and I'm saying and recognition criteria is met that we have discussed earlier, two criteria. The recognition criteria is met that future economic benefit will flow to the entity and cost is measured reliably. Then the same will be capitalized as intangible assets, otherwise it will be expense as income. So criteria for recognizing development expenses, expenses capitalized only if all below mentioned criteria are met. For internally generated, all these criteria need to be met. There should be technical feasibility of completing the intangible asset. Then there should be an intention to complete the intangible asset and use or sell it. The company should have the ability to use or sell the intangible asset. Then we need to see whether how the intangible asset will generate probable future economic benefits. Then the company should be in a position or having availability of adequate technical, financial or other resources to complete the development and the use and sell the intangible assets. पता चला कंपनी के पास फंड्स ही नहीं है to complete the development, then it will not be capitalized. Then ability to reliably measure the expenditure attributable to intangible assets during development. Development phase पे whatever expenditure that the company has incurred, it needs to be it has to be separately identifiable and measurable. आपके अगर सेम एम्प्लॉइज प्रोडक्शन में भी यूज हो रहे हैं और डेवलपमेंट में भी यूज हो रहे हैं एंड देयर इज नो लॉग मेंटेन्ड ऑन हाउ मच टाइम दे आर डिवोटिंग, देन देयर इज नो पॉइंट ऑफ कैपिटलाइजिंग सच कॉस्ट. So cost include cost of material and services, employee benefits, fees to register, legal right, amortization of patent and licenses, overheads to the extent necessary to generate the asset, and can be allocated on a reasonable basis. And in certain cases, borrowing cost is also capitalized. Suppose the entity is developing a patent or any technical know-how and has incurred borrowing costs, then if the criteria is met as per IND AS 23, it's a qualifying asset, then the interest cost will also form part of the total cost of intangible asset. We need to recognize the cost from the day the recognition criteria is fulfilled, and in case any cost that has been expensed to profit and loss and that will not be recognized as an asset subsequently. आपने जो प्रॉफिट एंड लॉस में चार्ज कर दिया वो कर दिया, उसके बाद जो भी कॉस्ट इनकर होगी दैट कैन ओनली बी एलिजिबल फॉर कैपिटलाइजेशन. जो चार्ज ऑफ कर दिया उसका रिवर्सल का देयर इज नो स्कोप and it can never be classified as an asset subsequently. Then there are certain costs which are not being capitalized, like selling, administrative, general overhead, inefficiencies and initial operating losses, expenditure on training staff to operate the asset. This is same as per IND AS 16. Then there is another case study. An undertaking is developing a new process. During 2014, expenditure incurred was 2,000, of which 1,800 were incurred before 1st November 2014, and 200 were incurred between 1st November 2014 and December. So on 1st of November, the recognition criteria was met, and the fair value of know-how in the market is 1,000. So let us see how this total cost of 2,000 will be accounted for. 1,800 is incurred before the recognition criteria is met, and 200 is incurred after that recognition date. So let us see how this will be treated. The intangible asset will be accounted for at 200 rupees, and the remaining cost, which is incurred before the recognition date, the same will be classified as expense and to be charged as expense in the profit and loss account. Right? In case of business combination, if the cost of fair value has to be at the acquisition date, uh, probability criteria is always satisfied and can be measured reliably, then if it is not to be cost, it cannot be measured reliability, cost cannot be measured reliability, then the differential between the purchase price and the net value fair value of asset is accounted for as goodwill. If the recognition criteria is met or cost is reliably measured, then the asset will be identified, it will be classified as a separate intangible asset, and the remaining will be classified as goodwill. And in such case, the amortization will be done based upon the useful life of the asset, and it will be clubbed together with the similar assets. Let us see the subsequent model. This is also same as we have discussed for the IND AS 16 property, plant and equipment. There are two models: cost model and revaluation model. In cost model, accumulated amortization, if any, and accumulated impairment losses is any cost less. This is the carrying value, cost less accumulated amortization and accumulated impairment, if any. In revaluation model, revalued amount less accumulated amortization and accumulated impairment losses. So this is also same with which we have just now discussed for IND AS 16. I am not repeating the same revaluation model. For amortization of intangible asset, if the asset is having finite useful life, then it is being amortized over its useful life. And impairment testing is done whenever there is an indication. However, if the life is indefinite useful life, then it has to be tested for impairment annually, or as well as when there is an indication. So basically, indefinite useful life के asset के लिए आपको annually impairment testing करनी ही करनी है. So these are the factors which determine the useful life, the product life cycle of the asset, technical, technological, commercial, or other types of obsolescence, changes in the market demand for the products, expected actions by competitors and potential competitors, the level of maintenance expenditure required, period of control over the asset. All these are the determinants of useful life of intangible assets. There was a rebuttable presumption in IGAP that the life of an intangible asset cannot exceed 10 years. However, such presumption is not there in IND AS 38. So an asset is de-recognized on disposal or when no future economic benefits are expected from its useful life or disposal. This is all same as per IND AS 16 also. Basically, there is not much difference between IND AS 16 and IND AS 38. Most of the recognition, measurement, and retirement criteria are the same, and de-recognition criteria is also same. So there are only certain disclosure requirements uh, for each class of intangible assets, whether we need to disclose whether the same is being internally generated or other intangible assets, whether useful life or indefinite or finite, useful life or amortization method and method used, carrying value, accumulated amortization, impairment loss at the beginning and at the end, and then reconciliation of carrying amount and revaluation amount. There are certain more detailed disclosures are required for uh, intangible assets with indefinite useful life, which we are not covering right now. Intangible asset measured after recognition using revaluation model and R&D expenditure. There are two key differences in this. IND AS 38 allows measurement either at cost or revalued amount, whereas AS 26 does not allow the revaluation of intangibles. And useful life may be infinite or indefinite, whereas in IGAP, there is a concept of, there is a rebuttable presumption that life cannot exceed 10 years. Then the one more difference is there relating to deferred payment. If payment for an intangible asset is deferred beyond the normal credit terms, the difference between this and total payment is recognized as the interest, which we have also discussed in our example. There is no such provision in IGAP. And subsequent expenditure on an in-process research and development project acquired in a business combination. बिजनेस कॉम्बिनेशन से रिलेटेड कोई सब्सिक्वेंट एक्सपेंडिचर है दैट विल बी डेल्ट बाय दिस स्टैंडर्ड, जो हमने सब्सिक्वेंट रिकॉग्निशन का सब्सिक्वेंट एक्सपेंडिचर का डिस्कशन अभी किया था सेम, whereas there is no guidance regarding the same in AS 26. Residual value is reviewed at least at each financial year. IND AS requires residual value को भी आपको रिव्यू करना है each financial year पे, whereas 26 में there is no such requirement. That's it. That's it from my side.
Thank you, sir. Thank you for such a knowledgeable session.
I hope मैंने टाइम पे क्लियर कर दिया. I was not too fast.
Yes, sir. Yes, sir. You are on time. So now I would like to invite the second speaker for today's VCM, CA Nisha Aggarwal ji. Hello, ma'am. She cleared her CA exam in 2009 and thereafter added more feathers to her cap by clearing DISA in 2016 and DIP IFR from Association of Chartered Accountants UK. She is having a vast experience of more than 10 years in finance, accounting and advisory service on standards on auditing and AS. Currently, she is working as partner in Bansal Company and LLP. She is also a registered independent director with Indian Institute of Corporate Affairs and active member of Young FICCI Ladies Organization. She has served the organizations such as Berkshire Hathaway Energy, Blackstone, Dabur, India Tourism Development Corporation Limited, Railtail, etc. She is also a visiting faculty with the Delhi University for certificate courses on IND AS. Now I request CA Nisha Aggarwal ji to address us on the topic. Over to you, ma'am.
Good afternoon, everyone. Thank you so much, Priya ji, Sumit ji, and entire team of CIRC for having me here. Thank you so much. And again, welcome to all our professionals who are investing, in spite of the stringent deadlines ahead for 10th and 15th, they are still investing their time and energy on learning these new skills or learning in this. And I thanks to Nitish for such a good deliberation on property, plant and equipment and other topics, because our next topic is somewhat related to property, plant and equipment. So thank you so much. Now, let me just share my screen so that I can start my topic. Priyaji, if you can confirm,
Yes,
is
ma'am.
my screen visible?
Yes. Your screen is visible.
Okay. So friends, our next topic is leases. So we have IND AS 116 and the corresponding international standard is IFRS 16. So in another 90 minutes, we'll be discussing in detail on the new standard on leases. Now we'll be discussing on why there is a need for the new standard. As you all know that we already had a standard on leases, which is IND AS 17. So why there was a need for the new standard? Then what is the effective date of this standard? Do we have any scope out items? What are the key highlights of this standard? Then there is a major change in the definition of lease in this standard. So we'll be discussing in detail about the new definition of the lease. Then there are some optional exemptions. We'll be discussing on the accounting in the books of lessee and lessor in this new standards. Then we'll be covering the transition, because all the companies were following the earlier standard IND AS 17, and once this standard came in, then how the standard required all the companies to transit from the old standard to the new standard. Then we'll be discussing the impact of this new standard of leases on the companies. Then what are the differences between our IND AS 116 and IFRS 16. Then in the last, I'll also be covering the amendments which came in July 2020 in the COVID scenario related to this new standards. So let's start. Now, the very first question, whenever we discuss this topic, this new standard on lease comes is, why new standard? We already had IND AS 17 on leases. Then why this new standard? Why there was a need for this new standard? So I have summarizes the need into 3 points. As you can see on the screen, see, correct, in the previous scenario, we all know that we had two different models of lease. One is operating lease and another is finance lease. So, sometime the reader of the financial statement, the user of the financial statement gets confused that why there are two concepts of leases. One company accounts certain type of lease as per different method where they recognize some asset, recognize some liability and say it as finance lease. On the other hand, there is another company who is also incurring huge expenditure on leases, but they are showing just in the expense in the P&L account, and there is nothing which is going into the balance sheet. So there was some confusion or some dilemma in the mind of the user or the investor, that why do we have two different treatments, two different models for this lease accounting. Then the second question was, the second issue was, when a investor, suppose I'm an investor and I want to invest in a company and I look at its financial statements. Now and the company is suppose expensing a huge amount of money into the rental part. Now, as an investor, obviously, I would like to, have more details about it. That for how, if I invest in this company, then for how many years the company will be paying this huge amount as lease rentals, and what I'll be getting in lieu of those lease rental. So you can say that as an investor, I want to see that I should have that. Liability part in my balance sheet, and whatever I am getting in lieu of the payment should be there in my balance sheet as an asset. So this was the confusion in the mind of investors or users of financial statements. So this new standard has addressed those concerns, and there is altogether different type of accounting which is now being suggested by this new standard. Then there was also a small point like there is not detailed or not adequate disclosures about the lessor's exposure to credit risk. Now, one more thing. If I'm sure many of you have seen the financial statements of airline companies. If you see the financial statements of airline companies before this standard, you'll be surprised to see that the airline companies, aircraft companies, their entire business runs around the aircraft. But if you'll see their balance sheet, you won't find aircraft in their balance sheet, the airplanes in their balance sheet. So that was little surprising, that how come this, like why the aircraft is not there in the balance sheet of the companies. So the reason was because, in most of the cases, these aircrafts are on leases, on long-term leases. So this was also, if you see what I have written on the screen, Sir David Tweety, who was the former chair to International Accounting Standard Board, he said in his speech to the Empire Club in Toronto in 2008 that one of my greatest ambition before I die is to fly in an aircraft that is on the airline's balance sheet, because that was quite surprising thing. That how come the the company is getting all the revenue from its aircraft and the aircraft is not there in the balance sheet. So that's why the standards got changed. Now we'll see that this standard has complete different accounting concept in the books of lessee. Now, what is the effective date? I have bifurcated it into two parts. If I talk about IFRS 16, it is effective. It was effective from the annual periods beginning on or after January 2019, and the earlier application was also permitted. And when it comes to Indian scenario, Ind AS 116, the new standard on leases, got effective from the periods beginning on or after April 1, 2019. So all of you must have seen that for all the listed companies, the balance sheet which they had just closed, that is for March 20, was the first balance sheet post this new standard, because the standard got effective from April 1, 2019. So the March 2020 balance sheet was the first balance sheet where we have seen the impact of this standard, new standard. Now, before we move ahead, let's see what are the scoped out item. There are certain type of arrangements, or there are certain type of leases which are excluded from this standard. Now, what are those leases? And these exclusions are there because we have a specific standard which talks about these leases. Hence, Ind AS 116 is not covering these type of leases. So what are those? Lease to explore for or use mineral, oil, natural gas, because we have a different standard. Then lease of biological assets is excluded. Then there are service concession arrangements. This is excluded. Then we have a certain lease arrangement where there is a license of intellectual property rights, and so all these are excluded. Then any type of rights held by a lessee which is within the scope of Ind AS 38, which we've just done with, are excluded. So these 5 items are excluded. These 5 types of lease are excluded from this standard. Now let's understand this standard. Let's see what is there in this new standard. Now, as I just told you that in our previous standard, we had two models. One is operating lease and another is finance lease. Now this new standard use a single accounting model for all leases. What does it mean? That means there is no concept of operating and finance lease in the books of lessee. Please note that whatever changes we are discussing in this standard, all of the changes are in the books of lessee. Means if you have taken any any item on lease, so the changes are in the books of lessee, and there is no change. There is just a minimal change. There is no change in the books of lessor. So whatever we are discussing here today is in the books of lessee. So earlier in previous standard, we used to have two models, operating lease and finance lease. Now there is no such concept. There is single accounting which we'll be doing for all type of leases. So this is the main change. Now the second change is, earlier when we used to pay some lease rentals, we just used to debit those lease rental in our P&L, and that's it, right? So, but in this new standard on lease, we have a new concept where we'll be recognizing one asset in our books, which is by the name of right for use. And we'll be recognizing a liability as well in our books, which is in the name of lease liability. You can say it is similar to the accounting we used to do for finance leases. So now for all type of leases which falls in this standard, I'm specifically highlighting this. Please note that for all type of leases which falls in the definition of this standard, right, will have asset in our books, which will be by the name of right for use, and a liability as well in our books, which will be by the name of lease liability. Then earlier, as I told, we used to have a rent expense in our books. Now this standard says that now whatever will be going into your profit and loss statement will be two things. One is your depreciation on your right to use asset and interest expense on your lease liability. So now if we are accounting as per this standard, you won't be seeing rent expense in your profit and loss. In place of rent, you will be seeing two items. One is depreciation, because you have two different things in your balance sheet. One is right to use. So on right to use, we'll be having depreciation, and then we have lease liability. So on lease liability, we'll be having some interest expense. So in P&L, we'll be seeing depreciation and interest expense in place of rental expense. Then because we are recognizing some liability in our books, and in case if the liability is in foreign currency, then obviously we'll be restating those foreign currency liabilities, so we'll have some fluctuation, some volatility in our P&L as well due to restatement of that foreign currency liability. Then please note, this is the main part of this standard, that there is a change in our definition of lease. When you are actually going to apply this standard in your professional life, you will be seeing that if you have to go through the lease document of the client, and then you have to analyze that whether this lease arrangement is falling within the new standard or is not falling within the standard, because the definition has changed. If your lease agreement, which is your client lease agreement, which you are analyzing, which you are accounting if you are a consultant, or if you are auditing if you are an auditor, so you have to see that if the lease falls in the definition of the lease given in this new standard, then only you will be doing this new accounting. If your lease is not falling in this new definition, then you will continue doing the same treatment. Like in old standard, what did we do? We used to take the amount to P&L as rental expense. So since this, if your agreement, if your lease contract is not falling within the new definition, then you will be accounting your expense like any other expense, right? So what do we do for any other expense? We take it to P&L. So simply you will be doing in the same manner. So please note that there is a major change in the definition of lease, which we'll be covering ahead in detail. Then I'm again emphasizing that there is no change in the accounting in the books of lessor. All the changes we are discussing, or which we'll be discussing, is in the books of the lessee. There is no change in the books of the lessor. There is just a small change. Earlier in IND AS 17 leases, we used to have a carve out. What was the carve out about? It was that if there is any, if there is any increase in your lease rental, if you are a lessor and there is increase in your lease rental, and those increase are in line with the increase in inflation, then you are not supposed to do the straight lining. So there was a carve out in our IND AS, but now there is no such provision in the new standard. So that means that carve out has gone. Now, whenever you will find any increase in the lease rental, then you have to do the straight lining. Yes, I see a raise of hand in between. If you have any question. Okay, or you can put down your question in the chat box and we'll take up all the questions at the end of the session. So this was the key were the key highlights where I have summarized the standard, like what are the changes in this standard. Now let's discuss one by one. Identifying a lease. This is the most important part of this standard, because it's not that we have to apply this standard for all the leases which are there in at your client place. No, you have to identify a lease. Yes, I can see some raise of hand. Do we have any question? Okay, so identifying a lease. Now let's see what is the new definition of the lease. Now the new definition of the lease says that what is a lease? A lease is a contract or a part of contract that conveys the right to use an asset for a period of time in exchange for consideration. Now let me break this definition into three parts. So the definition says that a contract or a part of contract, right? So what does it mean? It means that the contract may be exclusively a lease contract, or it can be, you can say, a service contract, or any contract where lease portion is a part of the contract. So it may be a contract or a part of contract where the right to use asset for a period of time. Now, please note two things here. Whenever we say right to use, as we all know that in IFRS or in IND AS, whenever we say right, or whenever we say risk and reward, now the definition has been completely changed. At everywhere we see from the control aspect. So that's why I have specially highlighted here or written for you that the right to use, whenever we are saying the right to use, it should be control. Now, right to use for asset. Now, asset should be identified. I'll be discussing it ahead in detail because it is very important. The whole standard revolves around it. The right to use of asset should be identified, and for a period of time in exchange for consideration. So let's discuss this. Now, when I said a contract or a part of contract, so that means suppose you have some combined contract. Now, if you are an auditor or you are a consultant or you are an accountant, you have to separate the contract into lease elements and into non-lease elements. Now, let me give you an example or a case study. We'll be saying how we'll be separating the portion. Now, let's say you took a godown space, right? And you have to pay 1 lakh rupees for 3 years period. Now, this payment includes the payment of rental of one unit, unit number 13, and its cleaning once per week. This you all have seen in, all the new commercial space, new commercial towers. Whenever we take any office on rent, they have similar type of arrangement that you have to pay this much amount, rental amount, and generally that amount is inclusive of the service portion. So similar is here in our case study that we have to pay. We have taken a godown space and the unit is unit number 13. Now I have to pay rupees 1 lakh rupees for next 3 years. And in that 1 lakh rupees, I'll be getting the space as well as I'll be getting the cleaning services. Now you find out that you would be able to rent out similar unit in the warehouse next door. Now you get to know that, okay, you have taken it out in rent for 1 lakh rupees, but you can get the similar unit, next to it for 90,000 rupees per year. But those 90,000 are without cleaning services, right? And you would need to pay rupees. And if you suppose you have taken for 90,000, and if you take cleaning services extra, then you have to pay 15,000 per year. So now, as per this new standard, what I told you is you have to separate the lease portion and the non-lease portion, and the non-lease portion your service part you will be taking it directly to P&L, like your cleaning and maintenance expenses, right? So now how you will be dividing, how you will be separating. So this standard says that you do it on the basis the relative standalone prices. Now in this case study, I have given you a hint on how to calculate. It is very simple. Like you are paying, you have to allocate the amount you are paying 1 lakh rupees per year into your lease portion and non-lease portion. So simply how I have done it, see the standalone price is 90,000 for pure rental portion. So I have calculated like 90,000 divided by this 105,000, 90,000 plus 15,000. So that comes to 85,710. So that means 85,710 is your lease portion and 14,290 is your service element. So what you will do for that service element, you will simply take it to your profit and loss and debit it like other expenses, like any other expense, like your cleaning expense and so. And so you are dividing your 1 lakh payment which you are paying into two parts, and you are taking this 14,290 which is non-lease portion to P&L. We will be discussing what we'll be doing for this, lease portion ahead. But in through this case study, I want you to give you an idea about how we'll be bifurcating our contract if we have some sort of combined contract. Now, in the definition, I told you that you must have right to use for an identified asset. Now, this is the second important part. First was that if you have a combined contract, you have to segregate it. Now, the second portion is whenever we say that we have to do lease accounting as per this new standard, you have to see that whether your asset is identified. So if it is yes, means if you have asset, you have identified asset for which you are paying, the amount, then yes, it is a lease as per this standard. If it is not identified, then it is not a lease as per this standard. You are not supposed to follow this standard. Now let's see, what do we mean by asset can be identified or not identified. Now let's see this. Suppose in our case study part 1, you occupy a certain area of XY cubic meters, but the specific place will be determined by the owner of the warehouse based on the actual usage of the warehouse and free storage. Now, in this case, you have entered into a contract with the owner of the warehouse that, okay, you will get, suppose 500 cubic meters, right? So you have entered into such a contract, such an arrangement. But here it is mentioned that your place is not determined. It depends on the owner of the warehouse. It depends on the usage of the warehouse. Suppose the owner says that, Nisha, okay, now you take this area at the entry, this is yours. And in the next month, it's the owner says, no, Nisha, now this is occupied, you please take the backside area, right? So in here case study, in this first portion, you can see that I am paying for certain asset, but the asset is not identified, right? The asset is not identified. My area is identified, no doubt that, okay, I have 500 cubic meter, but it is not identified that it is here, there, or like where. The owner of the warehouse can change it as per his usage. So in this case, in A part, the asset is not identified. So the lease contract won't be falling in this new definition, and you're not supposed to follow this new standard. You recognize the rent you are paying as any other expense you recognize in your profit and loss account. Now, let's change the scenario. Now, please look at the point number B. Now, the case study says that you will occupy unit number 13 of XY cubic meter in sector A of that warehouse. Now you can see the change in our example. Now the unit, the asset is fixed. In the warehouse, it is unit number 13 which is allotted to you. You can do any change in unit number 13 because you know that it is yours for this much period, right? So now in the second scenario, you can see that you have fixed, your asset is identified, you know for which asset you are paying your rentals. So we will be doing the new accounting in our contract, if the contract is like our case number B, where we can identify one asset. Or I can give you another example which you can correlate very well. See, whenever you go to the airport, right? Whenever you just enter the airport, if you see that there are different areas allocated to different airlines, like you can see a counter of Air India, next to it is a counter of Indigo, then SpiceJet and so on, but the counter is not fixed, right? Now suppose I am a aircraft company and I entered into an arrangement with the airport authorities that my area is fixed, that I'll be getting, okay, there's 300 square meters area, my area, 300 square feet area, my area is fixed. But the authority says that Nisha, today you can put up your counter here, but I can change your space, depending the demand from other companies. So if the case is like in the airports, we see that they keeps on changing. If they keep on changing the space, your area is fixed, but your space is not fixed. Suppose they have given me the front side portion, and next day Costa comes to airport authorities and says that I want to set up my counter in the very beginning. I want people to have a sweet aroma or coffee when they put their first step into the airport. So now the airport authority says, Manisha, please put up your counter, after Costa. So in these examples, you can see that the asset is not identified. The space is fixed, but asset is not fixed. So why we are again and again emphasizing that your asset should be identified? Because, when we see the definition of our new lease, it says that you should have right to use. Now you tell me, if your space is not fixed, how you can control the use? If you want to do some changes, or if you want to do some any additions or any sort of expenditure, how you will do if your space is not fixed? Today you have to put up your counter here, and next day you are told that you please shift there. So unless and until your asset is identified, you cannot have full right, full control to use. You may use that asset, but you are in genuine, you are not having the control. So that's why your asset should be identified. So whenever you're going to apply this standard, please see this point carefully, whether you have your asset for which you're paying rental is identified or not. Yes. Now you might be seeing these cases as well. Substantive right to substitute. Suppose you will occupy a certain area of this XY cubic meter for a 3 years period, but the specific, I think we have already covered this. This is just the explanation of what we have already discussed. Now, let's discuss this protective right. In many of the contracts, you will be seeing these type of protective rights, and then you will get confused. You will have a confusion that whether if these protective rights are mentioned, then whether asset is ours or not. Do we have control over the asset or not? So let's see, what are these protective rights? A contract may include terms and conditions designed to protect the supplier's interest in the asset or other asset, to protect its personal, or to ensure the supplier compliance with laws and regulations. Protective rights typically define the scope of the customer right of use, but do not prevent the customer from having the right to direct the use of an asset. Now that's why I read it for you, because see, whenever there are protective rights are not creating any hindrance in your right. Suppose you took a machine on rent, right? And the owner says that, Nisha, There are, this is the temperature under which you have to operate this machine. You know, you cannot be use this machine, you have to follow these standard operating policies to use these machines. So that doesn't mean that the owner is, you know, uh, what should I say, the owner is creating any interference in my right or usage. Rather, these type of rights, which we call as protective rights, are just there, which define the scope that this machine you have to operate in this manner only, so that it runs properly, so that you do not destroy my machine, right? So, or you can take an example like whenever we enter into any rent agreement, you can see in the terms it is written, the simple protective right terms are written, that you know, you cannot do any uh, activities which are against the law. You know, suppose if you have taken any warehouse, so you can see the conditions like you won't be you know, indulge in any uh, activities which are unlawful in nature. So these are just protective right. These, adding or having these right in the contract doesn't mean that the owner is preventing the this, you know, the lessor is preventing the lessee from its right to use or from control. No. So if there are protective rights, it is all fine. You have the identified assets, they are not creating, you know, any problem in your control. Now in the definition, I told you three parts. First is contract or subcontract, right? Then we read it like contract or subcontract. Then you should have a right to use, which we just discussed, that you should have full control. Protective right doesn't mean that you do not have right. Then your assets should be identified. Then we read it for a defined period, right, in exchange for some consideration. So now let's discuss the defined period as well. This is again important. What should be the lease term, or what is the meaning of lease term? Now this standard says that in determining the lease term and assessing the length of the, generally, okay, let me tell you, when we were in India 17, what do we mean by lease term? All of you must have seen that lease term means, you know, generally means the non-cancelable portion. Suppose I have entered into a lease agreement for 10 years, and that agreement says that you cannot, there is a lock-in of 5 years. So generally we say that yes, this 5 years, the lock-in period is the non-cancelable portion, right? So this is generally the lease, the definition of the lease term, or the lease term thing is. Now this standard has certain additional things. This standard says that you have to see uh, something more when you decide on the lease term. Now, what are those additional things? Now, the standard says that a lease is no longer enforceable when the lessor and the lessee each has a right to terminate the lease without permission. This is simply like if you can easily terminate, or what we call as a cancelable lease. So if we have a cancelable sort of things, then it is we do not consider it as a non-cancelable portion. The lease term begins at the commencement date and includes any rent-free period provided to the lessee by the lessor. Okay. See, whatever I am telling you, like I just told you that for a lease term, generally it is the non-cancelable portion, plus you have to see something else as well. So that something else is not clearly written in the standard. Rather, whatever points I have written here, we'll be reading these one by one, and then we'll be deriving the meaning of what I told you. So you should note that this rent-free period, uh, this is for the professionals who will, you know, who are working on the PSU clients. You might see this case that suppose I have a client and the client has taken a new office with the Delhi Metro Rail Corporation, right? So the client has taken a new office with a government company. Now, the generally in the contract, we see that there is a clause that, okay, you take the premises from April 1, Now, as you are supposed to do major renovation, so we provide you 3 months rent, 3 months period as rent-free period. You can take the premises from April. Okay, you go ahead with your renovation and we'll start taking rental from you from July. So April, May, June is the rent-free period, right? So this standard clearly says that for why we are discussing this lease term, because in our next slides, when we'll be discussing the change accounting, you will have to do the calculations for the lease term. So it is very important that you understand the new lease term so that you do not go wrong with your calculation. So this standard says that whenever you are going to calculate your lease term, please note that lease term begin when the contract starts, and it includes rent free. Means in our case, in the example I just quoted, the lease term will start from April, because the agreement starts from April, irrespective of the point that you have to pay the rent from July. No, the lease term starts from April. Now it says that if only a lessee has a right to terminate a lease, that right is considered to be an option to terminate to the lease available. Okay, so now this standard says that when you have to decide the lease term, first of all, look at the non-cancelable period, right? So in my example, like the rent agreement was for 10 years, but with a lock-in of 5 years. So the non-cancelable portion was 5 years. Now what you have to see is you have to see whether the manager or whether you are let me just cross check is yes. Now the standard says that you have to see that whether you have reasonable certainty that you are not going to terminate the lease. Suppose in my example, the rent agreement is for 10 years and the non-cancelable period is 5 years. Now the standard says that it's not that lease term is 5 years. The standard says that Nisha, look ahead 5 years. Please look that do you have any intention on the date of entering into the contract? Do you have any intention that you are not going to exercise the that you are going to exercise, I'm sorry, that you are going to exercise the renewal thing? Means if on the date of entering the contract, you know that you are going to exercise the option of extending the lease, though it is not in the initial lock-in period, but the management is reasonably certain that yes, we are going to exercise the option, then the standard says that please consider that as well in your lease term. You must have seen in many of the cases that, due to any reason, XYZ reason, we enter into a contract where the contract is for a long period, like the contract is for, say, 20 years. And the lock-in is only for 5 years. And there is a term that, we can mutually renew the contract. Now, in those cases, in many of those cases, we have seen that on the date of entering into the contract, the management knows that I have incurred so much expenditure on its renovation. I have, capitalized this thing, and I'm sure that I'll be using this asset for 10 years. But due to any XYZ reason, they put the lock-in for only 5 years. Now, this standard says in such scenarios, management has to consider that whether the lease term is 5 years or 10 years. It's not that blindly you will see the lock-in period and you will decide. You have to see these other things as well. Now, the standard also says that a lessee past practice regarding the period over which has typically used the particular asset and its economic reason may also, you must have seen in many of the cases that you enter, this generally happens in case of the rent agreements entered for employees, that you enter the rent agreement for 11 months, right? And when suppose I am an auditor and I check the agreement and I see, oh, this agreement is only for 11 months. Now we'll read ahead that this standard says that this new account in for this new accounting, we are providing an exemption that if your lease term is less than 12 months, then you may avail the exemption and you're not supposed to follow these complex accounting. So this standard is providing an exemption that if your lease term is less than 12 months, you can simply put the rent in your P&L as rent expense. You're not supposed to do this accounting. Now, suppose I am an auditor and I am reading the one lease agreement of employees of the client, and I see that, okay, the rent agreement, the lease term is for 11 months. The lock-in is for 11 months. Now I discussed with the management that, sir, where is the new contract? So they provide me another contract, which is nothing but the renewal of the same contract. Now I put a question that from how long the employee is, residing in this flat. So the management answers me like the employee is residing from the last 10 or 15 years. So now the question arises that though the form of the contract is for 11 months, but if you have a past practice, if you can see that it is your past practice that you generally enter it for 11 months, but the employees are living in the same premises from a long period. So this standard says that please consider that point as well, or please go with the substance over form thing. It's not that you have to just see the lock-in period. Look out other aspects as well for deciding the lease term. Now, the next portion is lease payments. In the definition, I told you the last part was for some consideration. So what are those consideration? The standard says that lease payments include any in substance fixed lease payments, like any fixed payments or in substance fixed lease payments are payments that may inform contain variability that in substance are not avoidable. Or you can simply say that lease payments means whatever fixed payments you are paying or whatever variable lease payments you are paying. In many of the cases you must have seen that your lease rentals depends on some index or some rate which keep on fluctuating. So the standard says that lease payment covers those type of payments as well. Then amounts expected to be payable by the lessee. In some of the cases you might have seen that there are some residual payments at the end of the term, so lease payment include that as well. Now the exercise of a purchase option, if the lessee is reasonably certain to exercise that option. Now in some of the lease cases again, we have seen that the lessee is given some option. So if the lessee is reasonably certain on day one, on entering the contract on day one, when you're going to account for this contract in your books, that you are reasonably certain that you will exercise that option, then the amount also you have to take into consideration for deciding the lease payments. And payment for penalties for terminating the lease, again, if you are confirmed, if you are reasonably certain, or if lease payment reflects that you are going to exercise the option to terminate the lease, so you have to consider the penalties as well. So in short, in simple, I can say that whatever you are going to pay in lieu of that identified fixed assets, be it your fixed payment, your variable payment, your penalty, which you can reasonably estimate on day one, right? So all those payments are your lease payments. So now we are done with the major definition, with the change in the definition of our lease contracts. We discussed that we should divide our lease contract. If it is a combined contract, we should see that we should have a control over the asset should be identified. And what is the meaning of lease term? It's not simply the lock-in period, or we have to see the total non-cancelable portion. Now, before moving, the next portion obviously is now what is the new accounting? So far, we have read only the terms, we have discussed only the definition. Now we'll be discussing what is the new accounting. I told you something in the beginning, like something like right to use, something like lease liability. So we'll be discussing it, but before moving into the accounting part, there is a happy point that yes, there are some optional exemption. If your lease contract is falling in the definition of the new lease, which we just covered, it's not that you simply have to do the new accounting. Wait a minute, see whether you fall in the exemption or not. If you fall in the exemption, then you are the lucky one. You simply recognize the expense like any other expense in your profit and loss. But if you do not fall into the optional exemption or you do not opt for the exemption, then you have to do all the calculations which we'll be discussing. So what are the two exemptions? This standard provide us two exemption, and please note that these exemptions are optional in nature. These are not mandatory exemptions. You may opt these or you may not opt these. If you opt these, you have to disclose these in your financial statements in detail as required by the standard. So the new standard says that if your lease term is less than 1 year, if your lease term is less than 1 year, then you have an option not to apply or not to go for these standard, right? So this is a little, just for giving the simple accounting to the small leases. And obviously, as I told you in the very beginning, that the idea of our change in accounting was to bring in the balance sheet the long term lease arrangements, these short leases which we generally have. If you see the balance sheet of if you see the financial statement of any company, all companies have leases, but all leases won't fall into this new standard because this standard has somewhat different accounting. So if your lease term is less than 1 year, which we generally call as short-term lease, you just recognize your lease payments in your P&L account, right? On straight line or any systematic basis. And the second exemption is underlying asset of low value. Suppose this standard, when it is written that underlying asset of low value, some professionals might confuse it as I get queries that Nisha, my client is paying a rent of just 10,000 rupees for an office premises, so can I take the exemption of this low value item? So my answer is no to those friends, because please note here what is written is low value asset. It is not low rental. If I have taken some office premises, obviously office is not of low value, the rental is low value. So this standard is not has not defined what are low value assets, but they have given some examples. Now see, the ISB intended the exemption to apply to lease for which the underlying asset when new, sorry, I think there is something missed here, when new asset is of low value. Example, they've given example like tablet, personal computer, some small office, and telephone, coffee machines, or similar items. So you can, or we can conclude it like, if like in our clients we have concluded it like, if the asset, it's not the rental, please note, if the asset which you have taken on lease is a low value asset like computers, coffee machines, Xerox machines, right? So if those assets are low value assets, then you can take this exemption. It's not that you are paying for an office premises and the value is, rental value is just 10,000 and you are taking this exemption. No, it would be wrong. So these are the two optional exemptions. Now let's discuss the accounting. in the books of lessee and lessor. Lessor, I have already told you there is no change in the books of lessor, except that earlier we had a carve out. Now the carve out is no more. If you have given something on rent and there is a increase in rental clause, then please do the straight lining and then recognize your income. So simple. Now in the books of lessee. In the books of lessee, at the commencement date, at the commencement date means when you have entered into the contract. Suppose I have entered into the contract on April 1, 2017. Let's take an example. I am preparing the books for the financial year 1920, which was the first financial year for this new standard. So suppose I am preparing books for the financial year 1920. I have taken some lease, I have taken some asset on lease on April 1, 2017. So this standard says that Nisha, you have to, and I am lessee, obviously I have taken asset on lease. So this standard says that on April 1, 2017, on the commencement date, you have to recognize two items in your books. One, you have to recognize right for use. You are, say, if you go to the logic as well, if you are paying for something and you have a contract which says that there is a lock-in, there is a lease term, you are committed to pay, you have fixed obligations, you are committed to pay this much lease rent for these many years. So obviously you have certain liability, right? So this standard says that bring those liability in your books on the commencement date. The date you enter into the contract, you have some liability, you have some lease liability. So please record that lease liability in your books. This is number one. Now, number two. Now, for that lease liability, why do you have that lease liability? Obviously, you are getting, you are getting the right to use that asset for the lease term. So that means you have certain asset as well. You have certain right as well. So the standard says that in your balance sheet, bring the right for use in your books. And on the other hand, on the liability side, you also recognize your lease liability. So you have to bring these two new items in your financial statements. Now, let's read what the standard says, like how do we calculate the lease. When I had said that you have to bring these in your books, then obviously you are supposed to calculate these. You are supposed to calculate lease liability. You are supposed to calculate right for use. So see how we will be recognizing lease liability. We have to see all the fixed payments, whatever amounts I'm supposed to pay for the lease term. Then all the variable lease payments, residual value guarantee, which we just read in the lease payments, right? Whatever I'll be paying, I have to write at one place. I have to jot down. So then I have to use a discounting rate. I have to take a discounting rate on the date of commencement, right? So I'll be taking a discounting rate and I'll be discounting all my payments. I have to plot the complete payments I have to make in the whole lease term, right? I have to return, okay, I'll be paying 10,000 monthly for next 5 years. Then at the end I'll be paying 1 lakh as residual value guarantee, or I might have to pay certain penalties. So you have to jot down everything, you have to write down everything. Then you apply a discounting rate, which is generally the rate given in your lease term, implicit rate, or the incremental borrowing rate of the same asset. So you take that rate and you calculate the present value of all the payments of your lease liability. Now the value which comes to you is your lease liability, which you are supposed to recognize in your books on the commencement date. So this is one lease liability. Now how we'll be calculating the right for use? The standard says that you start with the amount of lease liability. Whatever amount, suppose you have arrived, you have to pay 500 rupees over the next 5 years, and let's take 8% at the discount rate, and suppose the present value comes to 350. So how you will be, your lease liability is 350. Now how you will be calculating right to use? You take that amount for lease liability, you take that 350, then consider lease payments before or commencement lease dates. If you have already made some payments like prepaid expenses we have in our financials, so if you have already paid something, so you please deduct, you please consider that as well, because obviously you have paid that amount for that right to use. So you take the lease liability, means whatever you have to pay, then what you have already paid. Further, if you have incurred some extra cost as well, some direct cost as well, then please consider that as well. Plus, if you have to incur any dismantling cost in the future, so please consider that cost as well. So add up all these costs and then you will have your right to use amount, right? So we have discussed how we'll be calculating the lease liability, how we have to calculate the right for use. Now this is on the date of commencement, right? Which we say as initial recognition. This is on the date of initial recognition. Now what will we do for subsequent balance sheet dates, or how we'll be recording, how we'll be measuring these subsequently? Now after commencement, in the previous slide, we discussed about at commencement, means on the beginning, initial recognition, and now subsequent measurement, how we'll be measuring it subsequently. So for right to use, suppose you have calculated right to use as 120 and your lease term is 6 years. So this standard says that simply you do it like you do for any other property, plant and equipment. Just divide your this S right to use over the useful life. So useful life in our case will be 6 years, like the lease term for which we have right to use. So you simply have right to use 120 and you calculate depreciation of 20 rupees for another 6 years. So this is simply your accounting for right to use. Now for lease liability. For lease liability, you can say it like the accounting for lease liability is similar to any other financial liability. So what we do, I'm not sure if we have covered IND AS 109 or not, but let me tell you in simple terms, like suppose you have 100 rupees. Suppose what is lease liability is, for any financial liability, you recognize your financial liability on day one, right, at fair value. Then you, for subsequent measurement, you carry it at amortized cost. So how do you calculate it? Suppose you have to pay 100 rupees to one person for another for 5 years, 100 rupee on year 1, 100 rupee on year 2, 100 on year 3. So total you have to pay 500 rupees, right? So how do we calculate lease liability, or how do we calculate the fair value? We take a discounting rate, right? So we calculate the present value. Suppose for 500 rupees with 8% interest rate, my value comes to 350. So 350 is my fair value. So on day one, I'll be recognizing my liability at 350. So this is recognition at fair value. Then obviously you have recorded your liability at 350, but you have to pay 500 to that person, right? So what you will do is, over 5 years period, you have recorded at 350. Now over 5 years period, you will be increasing that liability so that at the end of 5th period, it comes to 500 rupees, because obviously you have to pay 500 rupees. The lender will ask 500 from you. He's not aware, or he's not worried whether you have recorded it in your books at 350 or 400 or any amount. He will ask 500 rupees from you. So what do we do in liability? We record at 350. Then over the years, what do? We increase our liability. We debit to finance cost and we credit to lease liability. And so when we call this as, first when you calculate the present value, we call it as discounting. You know, we discount 500 rupees to 350, and year on year, you know, over the lease term, when you are increasing the liability, we say it as unwinding. So we are unwinding our liability. So the accounting of lease liability is exactly same like any other financial liability. You have to book interest expense and you will be increasing lease liability. And when you will pay your rent, obviously you will be paying per year. So you simply debit your lease liability into cash or bank. Now in the books of lesser, I have already covered that. Okay, again, as I told in the beginning, now we have a single accounting model. There is no concept of operating lease, finance lease in the books of lessee. Please note that the standard has, you know, the new calculations and everything. The change part is for the books of lessee. If we talk about the books of lesser, then still there are two concepts. Like lesser will obviously analyze that finance lease, whether there is a finance lease or operating lease concept is still there in the books of lesser. So there is no change in the books of lesser. It is same as we used to do for IND AS 17. So I'm skipping it. Now transition. Well, by now all the companies have already transited into this new standard, so I was a little confused whether I should cover this or not, but I have not deleted it, so we may discuss it. I know that all of us have already prepared or audited financial statements for M20, but because the transition is similar to any other transition which we have, so I think it is in the interest that we can discuss it. Now the standard, there is a concept of transition. You already have lease in your books, your client already has lease in their books, and now there is a change in standard. So how the client is supposed to, or how you are supposed to transit from the old standard to new standard? Earlier you were only debiting your rental expense in P&L, and now the standard says that you have to calculate. And you must be knowing that whenever there is a change in any standard, whenever all the IFRS is based on retrospective calculation approach, there is no prospective prospective calculation thing in IFRS. Whenever we talk about anything or any change, it is always retrospective. So now if I'll suppose I have 10 12 lease arrangements, and those are 30 40 years old arrangements, so do I have to calculate from the very beginning, or like how I'll be transiting? So this standard has given the transition provisions, that okay, these are the transition provisions. Now they say, they tell some principles and you have to apply these principles while moving from the old standard to the new standard. This is similar like you remember when we transit to IND AS, when we were preparing the March 17 financial statement for IND AS companies, then we had questioned our mind that how we'll be transiting from the old standards to the new standard. So the ICI gives us, or the MCA gives us IND AS 101, that this is the standard which have all the transitional provision which will help you from moving from the old set of GAAP to the new set of GAAP, right? So that they brought up a altogether new standard because we have total change in GAAP. But whenever there is a new standard, whenever they issue some new standard, they put some guidance, they attach some transition provision that how you have to move from the old to the new one. So what is it? Now this says that you have two options. One is retrospective approach. As we all know that retrospective approach means it is similar to like it is as given in IND AS 8, that you have to calculate from the very beginning. Suppose I am in financial year 1920, but I have some lease agreements, and I entered into some lease arrangements in 2000, 1, 2, or any period. So this retrospective approach says that, Nisha, you calculate right of use, you calculate your lease liability on day one, on 2001, 2, or whatever was the commencement date. So this standard says you calculate from the very beginning, right? Then whatever is the change, you do that in your opening balance sheet. Suppose I am preparing for financial year 1920. So March 20 is my one balance sheet. March 19 is my comparative balance sheet for the comparative period, right? Two balance sheets. Now my opening point is, opening retained earning is April 1, 2018. So retrospective approach says you calculate from the very beginning, and whatever is the change, you recognize your asset on April 1, 2018. You recognize your liability on April 1, 2018. And whatever is the difference, means whatever is the change, you recognize everything on April 1, 2018. So this is retrospective approach. Now there is another option given, which is cumulative catch-up approach. So in cumulative catch-up approach as well, we have two options. I'll be sharing an Excel file with you because this might seem, some complicated thing to you. But once we discuss with our Excel thing, it will be quite easy for you. So I'm just sharing another file. If anyone of you or Priyaji can confirm that.
Not visible yet.
Just a minute, just a minute. No, just a minute. I'm just sharing the Excel file. I'm opening it. Please allow me a few more seconds. It is taking time. Is it visible now?
Yes, ma'am, it's visible now.
Okay. So let's simply take an example. What we are discussing is, we are discussing the approach, the transition approaches given by the standard. It says you have two options. You can go for retrospective approach, or you may go for cumulative catch-up approach. Then again, in cumulative adjustment, it is providing me two options. So I have mentioned option 1 here. Option 1 is the retrospective approach. And in the cumulative catch-up approach, there are two options, option 2A and option 2B. Now let's see these options one by one. Now what we have to do, suppose you have a lease agreement which started on April 1, 2017, right? Now the lease agreement says that, Nisha, it starts on April 1, 2017, and you have to pay 100 rupees for next 5 years. So what I have to pay is, I have to pay 500 rupees. So what I'll be doing, as I told you, is on day 1, means or April 17. Now this approach, this full retrospective approach says you calculate from the very beginning. So please see on the screen, I have calculated from the very beginning. I have plotted the payments I have to make for the entire lease period. It is total 500 rupees. Then I'll be taking the discounting rate, the implicit rate, or the incremental borrowing rate on the commencement date. So I have taken the rate for April 1, 2017, right? So it was 8%. So I have discounted the rentals I have to pay using this 8%. So it comes to, present value comes to 431, right? So the present value is 431. Now, what our standard says, what our IND AS 8 says, IND AS 8 says that whenever you do something, anything retrospectively, you make all the adjustments in the opening retained earning, right? So as I told you in my example, I am preparing financial sub. Let's continue this example. We are preparing
And
for
PPT
financial
is
year
not visible.
1920. So what is our opening balance sheet date? We are preparing for March 20.
Hi, Nisha, sorry to interrupt. I think
Yeah,
your
yeah.
PPT, your Excel sheet you have not opened.
Oh,
Have
I'm
you?
sorry.
Okay, okay. It is no, your Excel sheet is not visible.
You are still
We are
seeing the
just,
PPT on the screen?
no, we are just seeing your folder where
Oh,
IFRS 16 and PPT
okay,
transition
okay, okay.
example sheet is
Just a
visible.
minute. Just a minute. Is it visible now? Is it visible now, the Excel sheet?
Yeah, visible. It's visible.
Okay, I'm so sorry. I'll repeat it quickly. See here, I have plotted my option. We are discussing option 1. It is full retrospective approach. I have plotted all the payments I have to make for the whole tenure, for whole lease term. So it comes to 500 rupees. Then I have taken the discounting rate on the commencement of lease term. So I have taken discounting rate 8%, which was there on April 1, 2017. So the value, when I'll calculate the present value using this discounting rate, it comes to 431, right? So I have done the calculation from the very beginning. Now the standard says that, Nisha, you have to make when you have to calculate from the very beginning, right? And you have to take the effect on your opening retained earnings. So what is the date for my opening retained earnings? If I'm preparing balance sheet for financial year 1920, so I'll prepare balance sheet for March 31, 2020. Comparative period will be March 31, 2019. And the period will start from April 1, 2018. So I think all will agree that all the adjustments will be on April 1, 2018. So you can see I have highlighted in green that this is my amount on April 1, 2018. You can see it is M18, right? So March, whatever was there on March 18 should be there on April 1, 2018. So I'll be recognizing right to use asset 345 on April 1, 2018. Then I'll be recognized, okay. Now, as I told you, I have calculated the lease liability as well, right? Like 431 was my present value. So I told you that I'll recognize the fair value of lease liability is 431. Then this is the calculation for amortized cost, that opening minus rent payment plus interest, and this is my amortized cost. So 345 is my right to use. 358 comes out to my lease liability, and whatever is the difference, it is like 12.74 will go to my retained earnings on April 1, 2018. So this is my first approach. The standards say you calculate from the very beginning, and whatever is the change, you recognize it in the opening retained earnings, right? So this is first option. Now in the second option, in the modified retrospective approach, this we call as full retrospective approach. Full retrospective means retrospective effect is given in totality. Now the second option, 2A, we call it as modified retrospective approach. What is there in the modified retrospective approach? Modified retrospective approach means there'll be two changes. Obviously, because the name is retrospective approach, obviously you will be calculating from the very beginning, but you can do two changes. You have to take the discounting rate on the date of transition. Means for us, for India, transition is April 1, 2019, because the standard become effective from this date. So I have to take the discounting rate for April 1, 2019. which is 12%. So here, this is change number 1. In my first option, I have taken the rate on commencement date. Here you have to take the rate on the transition date. So my this rate is changed. Now you see the entire calculation is same. The figures are changed because obviously my rate has changed. So what it was, present value was 431 in option 1. Now it comes to 404 and so on. The figures have changed. Now the second change is, in earlier option it was full retrospective approach. So I had to change the March 19 figure as well. I have to change April 1 2018 figure as well. But in this option, in modified retrospective option, you are not required to change your comparatives. The standard says that no doubt you have to calculate it from the very beginning. You calculate it from the very beginning, but whatever whatever figure or whatever the new thing is there, you recognize on your transition date. So for me, transition date is April 1 2019. So see, I have calculated from the very beginning. Now April 1 2019 is this M19, the portion I have highlighted in green, 242. So on April 1 2019, I'll be passing an entry in my books. I'll be bringing right to use in my books. I'll be debiting 242. I'll be crediting 269, and whatever is the difference, like 26, I'll be taking it to retained earnings. So this is the second option given, which we call as modified retrospective approach. Now there is one more option, which is very simple option. Now this option says that don't do calculation from the very beginning. We generally call it as cumulative catch-up approach. So this standard says that do not calculate from the very beginning. You just see what you have to pay in the balance remaining period. So you can see in my example, because I am preparing for financial year 1920, I am doing it on transition date April 1 2019. So I have plotted only 3 years rent, March 20, March 21, March 22. So I'm not calculating from the very beginning. I am calculating from the transition date. So I have plotted this, right? 300. Then I have calculated the present value, which comes to 269. So on April 1, 2019, 269 is my right to use. And in my example, I have not taken any, like in my slide, I told you first I have to calculate lease liability. Then for lease asset, I have to start with lease liability and I'll be doing certain additions. So in my example, I have not considered any addition. So both will be same. I'll be recognizing right to use by this amount and lease liability by this amount. So this was all about the transition options given by the standard. Please, okay, I'm resharing. Yeah, if you can just confirm me on visibility of my PPT.
Yeah, it's visible.
Okay, so we have discussed these two options. We have already covered this case in my example. Now, I would also like to discuss on the impact of companies, like which companies have impacted, or if you, I told you that you have two options while transiting to IND AS. So as a professional, you might be confused that, Nisha, which option we should go for, right? What is the criteria? Or it's not like a toss that if head will come, I'll go to full retrospective, otherwise this. So let's see what companies have done. What are the impacts of this on companies? So I have taken few companies from different industries and I have jotted down the impact for you. So let's see. For Infosys, first of all, Infosys have used modified retrospective method, means option 2 in our case, modified retrospective approach. So they have calculated right to use. They have recognized right to use in their books, 2907 crores. Then they have recognized lease liability by 3,598 crores. Then the difference they have taken to retained earnings is 40 crores. And there was, so this was done on, in option 2, we read that we have to do all the changes on April 1, 2018. So they have done this on April 1, 2018. And for P&L portion, they are saying for 1920, they are writing that the effect of this adoption is insignificant on the profit for the period in earnings per share. So there is no such change in Infosys case. You can say it like, obviously, because they had arrangement, so they had these, major assets in their books liability. But for P&L portion, because addition of depreciation and interest expense versus what they used to book in their financial statement as rent, there is no such change in P&L portion. So this was the impact on Infosys. Now let's move to the hotel industry. So I have taken Indian Hotel Company. Now they have followed retrospective approach with cumulative effect on the date of initial application. That is, again, it is option number 2. They have calculated retrospectively, but the changes they have taken on initial application means April 1, 2019. So again, right to use asset 83181, it's a good amount, right? So lease liability again around 901 crores. Then cumulative effect which they have taken to retained earnings is around 101 crores. Then there was impact on their PBT as well. So basis my study, I have seen that most of the companies have followed option 2, the modified retrospective approach. Now let's see Indigo as well, because this is the industry we were talking about. Now retrospectively, with the cumulative effect of initially applying this standard on on the opening of retained earning as on the date of initial application, same treatment, right to use. Now you can see it is 13,000 crores. So recognizing right to use of 30, now this is a huge amount. 13,000 crores were recognized as right to use asset. Then 19,000 was recognized as lease liability. So these were, I can share this PPT with CIRC and they can further share if you want to see this in detail. Because we are left with 10 minutes and I want to cover 2 other aspects as well. Now, in my every webinar on financial reporting or IND AS, I highlight that, friends, whenever you are reading or learning any IND AS, you must read the corresponding IFRS as well. You must read the international corresponding standard as well, because we know that there are very few changes. So whenever we have any international clients, if you have the knowledge of IND AS, you should be very confident that yes, you know IFRS as well. Yes, you know the global standards as well. So it's important. I appreciate that we discussed the same in previous sessions as well. Nitish also covered what are the differences in corresponding international standards. So yes, there are just 2 changes in IND AS 116, or let me read it like, in IFRS 16, when we talk about or in IAS 40 investment property, we have 2 options. We have a cost approach as well as fair value approach. So they have certain now in IND AS 40 we have only cost approach. We do not have any fair value model. So whatever guidance was given in IFRS 16 with respect to fair value approach, we have done away with it. So this is a little change in our standard. Then our IFRS 16 give us an option that whatever is the finance element, whatever is the interest element on lease liability, if you are preparing cash flow, then you may present it in operating, you may treat it as operating or financing activity. but we have not considered that option. We have written that we will be treating it as finance activity only, because it makes sense to us that yes, it is a finance cost only, it is a time value of money. So there are just these two changes. Now this standard came in 2019. It got effective from April 1, 2019. But I also want to cover the amendment which was issued in the last year. We all know that due to this pandemic, due to COVID, many of the corporates have revised their this lease arrangements. Can you just allow me a few seconds? I'll put my laptop on charge so that it might not get off. Just allow me a few seconds. Yes, please. So we all have seen that many of the corporates have undergone or have renegotiated, their lease contracts. So there was a lot of discussions in the market that when we talk about, there are certain criteria mentioned in the lease contract that if you have any change in scope, the standard says that if you have any change in scope, if you have any change in the payment considerations, if there is any such change, then we will treat it as lease modification. And you have to, do some complex accounting, or you have to recalculate things. Now, this was addressed by IASB, the standard setting body for IFRS, International Accounting Standard Boards. They issued an amendment, and in the same line, India as well, MCA issued a notification in July 2020, which what was the notification about? The notification was that if there is a change in lease rentals, or if there are change, if you have rent concessions which are purely due to this COVID pandemic, if there are change in lease terms, if there are rent concessions which are purely due to this COVID-19 pandemic, then okay, we allow you some practical expedient. Means you're not supposed to consider it as lease modification and do the complex accounting. No, we are considering it as a practical expedient. And what you have to do is, what you have to do is, now you can see on the table, there are two columns. One is practical expedient not applied. Means suppose you have rent concession, you have change in your lease terms, and you are not, this practical expedient is optional. You may apply it, or you may not apply it. So if you are not applying practical expedient, means you are considering it as lease modification, then this is second column. And the third column is the practical expedient is applied. Suppose you say that no, I have lease concession, I do not want to go into complex accounting, and I'm availing the option given by this amendment. So what it is, effect on lease liability. See, obviously, we saw that how do we calculate the lease liability? Lease liability is whatever you have to pay in the entire lease term. So obviously it will be a change because there are rent concession. So you have to calculate the lease liability, right? But if you are going by the amendment, if you are going by the option given in the amendment, you are not supposed to change the discount rate. Whatever calculations you have done, whatever rate you have taken, you simply take the same rate if you are going by this option given in the amendment. So it has simplified the accounting a little. Means if you are not going by this assumption, this amendment, or had this amendment not been issued, then you were supposed to do entire recalculations for this change in your lease structure. But now this amendment came in, it is saying that you have an option, you can do a simple accounting. You obviously will recalculate your lease liability, but do not change the discounting rate, and let's not change the right to use assets. right? You recalculate your liability, and whatever is the change, you just take it to P&L account. So this is the change. Now, what are the conditions to avail this practical expedient? I have written 4 conditions on my screen. You must follow, or you must qualify all these conditions. Rent concession should be purely because of COVID-19 pandemic, please note. Then revised consideration should be either same or less than the consideration before the change. Then only it will be considered as this COVID. Why I am saying this? Suppose there are change in considerations, like it may be the case that you are deferring of this thing. Suppose there are no rent concessions, rather there are deferment of rent payments. So this standard says that if the total consideration before change and after change is either equal, means deferment is also covered, or there is a reduction, then you have to you may go for this option. Then rent concession should affect only lease payments originally due on or before June 30, 2021. If only the renegotiation is for the rent which was due on or before June 30, then only you will go for this. And there should not be any substantial change in other terms and conditions. If you are complying with all these conditions, then you can go for the amendment, and you have to give the disclosure in your financial statements. So excuse me, because I have not considered the presentation and disclosure parts. There are quite detailed disclosures in this new standard. IND AS 116 has detailed disclosures. You may refer financial statements of any listed company for March 20 for having those change disclosures. So that was all from my side. Now I am open for questions.
So are there any questions from attendees side? Attendees may write down their question, or even they could avail raise hand option on the screen. Until now, I can't see any question on the screen, or there is no raise hand option
Okay, it's
available.
okay. If anyone has any question, we can take up the questions. I also appreciate, because professionals are taking this session from 3 p.m.
Hi Nisha,
3:30
this is
p.m.
Sumit here. Thank you for the deliberate and the detailed presentation. You and Nitish took good sessions. Just my one query, which is not directly related to IND AS 116. Now, as per your standard, the standard suggests we should now disclose depreciation and interest instead of rent payments. So for disclosure purpose, I will show depreciation and interest. But when I'm making actual payment, I need to deduct TDS on as a rent. So it will have a mismatch in my reportings. So when my tax auditor is auditing, he will show me as a TDS on on rentals. So it will not mismatch. So any guidance came yet on this, how to deal with this kind of issue?
I see taxation. I do not practice in tax, but as far as my knowledge goes, there is no such guidance available so far. But yes, TDS will be as per the actual terms only, like rental portion only.
Nisha, may I add on this?
Yeah, please.
Yeah. Sumit, as per the guidance note on tax audit, we need to prepare a reconciliation for the same. It's up to the auditor that he needs to be satisfied whether TDS has been correctly deducted and deposited or not. So it has to be as per the section 194 rent only, and there will be another reconciliation, और आजकल तो वैसे भी reconciliation का ही season है, so एक और reconciliation add हो जाएगी. एक नहीं, बहुत सारी reconciliations add हो जाएगी.
Yeah, that is my actual worry,
So I
because
think
there
it's
will be too much
good for
reconciliation.
us, right?
Yeah, it's good for us.
As a professionals.
Right.
The more the chaos, the more assignments we'll have. Thank you.
Yeah.
Exactly, sir. So thank you, ma'am, for such an amazing deliberation. And now, with the end of the VCM, I would like to deliver my special thanks to CS Sumit Dadda ji for being the co-person behind the idea of organizing the VCM on this topic. Thank you, sir. Thank you so much. Thank you, everyone. Thank you, attendees, for being the patient listener for the day. With this, today's VCM comes to an end. Jai Hind, Jai ICI.
Thank you so much.
Thank you.
Thank you.
Thank you, everyone.